Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we're joined with Dave Wolcott. How you doing today, Dave?
Doing great, Kirk. Grateful to be here.
Great. Well, Dave, before we kind of dive right in, why don't you tell the audience a little bit about your background?
Yeah, sure. So probably like a lot of other listeners out there, started in a middle class family. I was raised there and figured that basically the recipe for success was to go to school, get good grades, right? And that was, the path to success, right? So I followed that conventional wisdom and ended up doing the ROTC program at GW and went into the Marine Corps after that. And in the Marines, I learned a ton of things they don't really teach you outside of school, right? Things such as leadership, integrity, and teamwork, right? These things that you just can't really get anywhere else. After that, I transitioned into corporate America. And for me, Kirk, it was a really tough transition, right? I really lost that sense of purpose, that sense of mission. And, it was really frustrating transitioning to corporate. And at the same time, my wife and I actually had a toddler. And then on October 24th, 2000, we actually had triplets. So literally quadrupled the size of our family. And so the first thing I did was go to see my financial planner, right? To figure out how am I going to provide for my family. And I got really frustrated with what, traditional financial planning was saying, which was, market's going to go up, market's going to go down. You'll make 7% over the long term. And I knew that the ultra wealthy were not really building their wealth that way. So this really launched me on an obsessive journey to figure out how the top 1% are really building their wealth, right? Because I knew it wasn't as a retail investor in the stock market. So the next 20 years, I spent basically investing in alternative assets, everything from oil and gas to raw land to retail to multifamily, lots of different asset classes. I built a few businesses as well. And there I learned a lot about tax strategy. And so fast forward 20 years, and we just launched our book called The Holistic Wealth Strategy, which is really, a 5-phased approach to helping people understand, how to build wealth outside of Wall Street in a non-traditional way.
So, yeah, that's great. So why don't you tell me, Dave, how did you kind of, I know that was the path, but like, where did you start? I mean, you've done a lot of different things, a lot of different alternatives, and that each one has its own kind of detailed skill set and understanding. So kind of where did you start on that journey?
It's interesting, Kirk, and this is why I really kind of developed, this overall holistic wealth strategy, right? Because where I really started was getting educated, right? And realizing that there were options outside of Wall Street. And keep in mind, this is around 2000, right? So they didn't have great podcasts like this. There weren't tons of resources, So I started pouring through different books. I started networking and really trying to increase my relationship capital to try to meet different people that were connected and like-minded to get into this. But it's all about mindset, and I find, look, we're just kind of rolling off the holidays and it's similar, right? You go home and you talk to your family members or friends about a great investment you just did in a multifamily syndication. And for a lot of people, they don't get it or they don't want to get it, right? Because they might have limiting beliefs from their past. They might say it's too risky because they don't understand it. So I think it all really starts with mindset, Kirk.
Yeah, no, I totally agree. I think that's a great first approach. So what was your first alternative asset you went into?
The first one was really an office building, and got into the office space in Dallas, Texas, and that did well. The occupancy was fairly strong. Learned some of the ins and outs, right, in terms of what the risks were to the investment, but you started getting that predictable passive income coming in. I started to get a lot smarter on bonus depreciation and how that works and trying to really offset the income that's coming in. And that was really the basis for it. And then, I essentially created our investment thesis over that, Kirk, which I believe is the trifecta in investing, which is essentially that we want three different dimensions when we go after an investment, right? So the first one being tax efficiency, right? We always want an investment to be tax efficient. We're always looking for predictable passive income. And then lastly, we're always looking for some type of forced appreciation so we can get some upside on the back end. And if I compare that to typical equities markets, if you have $1,000 worth of Tesla stock, you're only hoping it can do one thing, which is go up in value, right? Or they're going to increase the dividend. That's all you can really do. But in this case, you actually, you can get an exponential multiplier because you can win in three different cases, or, reduce your downside in three different dimensions as well.
Yeah, no, I agree. I think it's a good approach, focusing on all three of those. I think the forced appreciation is usually what people focus on, and it's probably the least predictable of the three, right?
Correct.
So, all right, so cool. So I'm glad you're able to have some success. Now, you mentioned passive. So are these actually passive investments, or are you kind of actively managing or facilitating these investments?
So that's a great question, Kirk. And I think a lot of people really don't give enough thought to this, being an active or a passive investor. Okay. They might read a book, maybe get inspired by Rich Dad, Poor Dad or something, and then want to go out and do, house hacking or, fix and flip, single family rentals. But at the end of the day, you cannot forget about the opportunity cost, right? Because at the base, at the core of this, you are your biggest asset. So where do you want to spend your time? So I learned that investing is a team sport, and I would rather invest passively in, let's say, a multifamily syndication where there's someone who's got, 20 years of experience on the acquisition side, on the asset management side, right? They completely know how to source off deal markets, manage them really well, and really optimize them. If I came into that game and did that, first you got to really love it, and then you got to be really good at it. So I think it's really important that people should double down on their strengths and their unique ability and what they're actually really good at, and then you'll see the biggest amount of return on that.
Okay. So let's kind of dig into some of the alts that you went into. You started talking about real estate, but what else? What other areas have you kind of looked
So
at?
I like to look at it in terms of solutions, Kirk, right? We're always trying to provide solutions. So we're typically working with very high net worth individuals, say entrepreneurs, and people are looking for, trying to solve different big financial problems that they have in their life. So one of the biggest problems people have is actually taxes. Right. It's the number one biggest wealth destroyer there is. Well, we have an oil and gas fund that's actually 100% tax deductible against your active income, against your total AGI, right? So if you're a doctor making seven figures, or a dentist, right, or a high net worth entrepreneur, and you can reduce that taxable income, that's money in your pocket right out of the gate before you even get into the returns. And in this case, right, we still have this three-dimensional return in the oil and gas fund that we're having, which is you're able to get that tax efficiency, like I said. It also has predictive passive income, which is double-digit returns. And then you've got some forced appreciation, which they sell to either a larger producer or an income generating fund, such as like a pension fund.
Right, but I mean, oil and gas is a little bit different. I mean, yes, you get the tax benefits, but having tax benefits and losing all your money are not the same thing. So, if you're investing in an oil and gas investment, you're talking about a fund, but just say an individual investment, the tax benefits are great, but they still have to have success in the well.
Correct. And there's lots of ways that we reduce this, but also going back to our investment thesis, Kirk, right? We're really investing in assets that are non-correlated to the markets. And if you think back to Maslow's hierarchy, right? And at the bottom level of Maslow's hierarchy, it's things like, food, shelter, energy, water, right? These key things. So last time I checked, the demand for energy on a global basis is literally, not going down anytime soon, right? I mean, it just keeps expanding. And we're seeing this, today, whether you're, take an airplane trip or you go to the pump and kind of fill up, right? And nothing is really going to, change that in the foreseeable future. So we want to be aligned where the macroeconomics are really strong. And, we believe that, based upon the demand, it's a good place to have a position, but I would never recommend, putting all your eggs in one basket, right? But having some exposure to the oil and gas sector right now, especially where we are in the economy, is a prudent move.
Right. No, no, I understand that. I guess what I'm getting at is, there's very specific risks. So you're talking about a lot of the opportunities, but where are the risks in some of these investments that you're looking at?
Well, sure. So just on the oil and gas side, right? It's the industry's come a long way, right? And typically it used to be very speculative. And like you talked about, they would go drill a particular well, just one, right? And if they came up dry, there was nothing there, right? Well, there's lots of technological advancements. Now they can do actual 3D seismic imaging. And we go after what's called PDP, which is proven developed production. So we know that there is oil underground, right? And it's a matter of actually extracting it the right way, optimizing it, things like that. So that's one way we reduce risk. And then we're also going after, these funds consist of, in this case, this one is 20 to 25 wells across 5 different basins, right? So we reduce our risk that way. And the fund is also 50-50 between gas and oil. So you're able to, hedge your bets that way because the prices aren't always correlated.
Okay. So, so you mentioned, I mean, with these alternatives, there's certainly, each one has their own economics. Where do you see the opportunities now, given where the economy is and the stock market, and where are you seeing opportunities?
Well, I think there are going to be some great opportunities on the multifamily side. People who've had their loans that are coming due this year, and they just don't have enough capital reserves, and they might have to, fire sale the asset. I think there's going to be a lot of good assets coming onto the market this year on the multifamily side. Same thing with self-storage, right? Some of those mom and pop operators who weren't necessarily positioned well.
Okay. So you think that's going to happen that quickly? Because I mean, right
Yes, we're
now,
already starting to see it. Yeah.
so where do you see, where do you kind of look at it and say, wow, this is a good deal? Like, how much below market price do you need to see before you say, hey, this is a good deal?
Well, I mean, just to give you an idea, and some of the listeners out there, Kirk, I mean, like on a multifamily, say a $50 million, 200 unit building. I mean, some operators have gone from paying 80,000 a month in their interest expense up to 300,000. Right. I mean, that is just a massive jump, right? So obviously the real estate sector is very interest rate sensitive. So again, if you didn't have any foresight, or you're more of an inexperienced operator and didn't, plan for these fluctuations, by putting contingencies in place, like having rate caps or things, I think that there are going to be some opportunities, and we're seeing some of that, some of those distressed assets already start to come on the market.
Yeah, I guess where I'm getting at is, I mean, the market is still expensive. So are you looking like 5% below, 30% below? Like, where do you see that kind of that price range where it's like, all right, because if people are saying, hey, I'm going to fire sale is 10% below, that's not really a fire sale. So do you have like targets in mind?
Well, I mean, it's a great question. And again, real estate it's very local in different markets. And, if you have a big sale on, say a 50 million or an $80 million asset, it's very different than a $4 million asset, right? The numbers are proportional. So, but we typically focus on markets in the Southeast and the Southwest. And, if you look also again on that macroeconomic standpoint, right? I mean, just look where people are leaving states like California, right? Where the taxes are really high. It's difficult to work, right? If you're a small business, things like that. And they're moving to states like Texas, Arizona, right? So Phoenix, we have a deal right now in Phoenix, Arizona, which has just been a super strong market, in the top 10. It's got a lot of diversity, a lot of people moving there. Same thing in Florida, Carolinas. We want to target those places that you have a higher influx of job population, as well as the job and population. Yeah.
Okay. All right. So I guess another question would come to mind is, as you're looking at more of a holistic strategy, how do you look at, this as a whole, right? You've got a bunch of different alternatives all spread out. How do you look at it as one big pie? Like, what's your strategy as a portfolio level?
So another great question, right? Because this all starts really with creating your vision statement. So if you don't have a target, you're going to miss every time. So I think it's really key to get crystal clear on what exactly you're looking for. So maybe is that income, is that, for some people, they want to have their passive income exceed their expenses. So what would that take? Right? Does that take a $2 million portfolio that's yielding 10% a year in passive income, and now you have 200K in passive income? What is that? And that it means something different to everyone, right? Or maybe you're a doctor and you want to stop practicing, right? Because you're burnt out, or you're not going to be able to practice at a certain time, so you want to get to a level of passive income. So that being said, once you can identify, right, what your goal is, what your vision statement is, you can start aligning different asset classes to do that. Some asset classes are heavier on the front end in terms of cash flow that you're getting, right? Others might be more tax efficient. So if you're in that active income or W-2 type scenario, you might want to have more of a predominance of something like oil and gas, right? That's offsetting that, because that's part of your strategy. I think also having a very proactive tax strategy is absolutely key to this, because again, I think we're so used to Wall Street and being productized in nature. It's like, hey, this return's doing 8%, that return's doing 10. But in reality, what if I could reduce your taxes by, say, 10 to 15% on top of, making a 20% in an alternative investment, right? I mean, now you're talking 30%, right? So it is about looking at the entire portfolio really from a holistic level. And again, like I said, really focusing on, where do you want to be? The favorite question I love to ask investors is, if you had $1 billion today, what would you be doing? Where would you be? And who would you be with?
Yeah, I think that's more of a holistic question than a tactical question with the portfolio, though, right?
Correct. But I think, right, I mean, if you think about really the psychology of money, right? I mean, money is really a medium of exchange. So, and you can always get more money, but what are you getting money for? You want to start a foundation? You want to retire early? What is it that you're really trying to do? And I think that should help to dictate, some of the moves on your chessboard that you're going to make to align your portfolio to that.
So how do you look at risk as a portfolio level? Like, how do you look at risk management for, investments as an aggregate?
So another good question. I think everyone has different risk tolerances. Obviously, we in the alternative asset space, I mean, we're always looking for asymmetric, risk adjusted returns. I always find it strange that Wall Street talks about these as alternative investments, but last time I checked, real estate's one of the oldest asset classes that's been around, forever, right? For centuries. And again, if you think about Maslow's hierarchy, people need a place to live. So, if we go into this recessionary period, maybe people, give up, going out on vacations, certain discretionary spend that they might have. But you can't really, not live anywhere, right? You have to live somewhere. So I like to look at a lot of the macroeconomics and some of those fundamentals that point us, into the asset classes that we have. Because, frankly, to me, when I look at the equities markets, it just seems like it seems like the stock market to me, or just a casino, right? You can wake up in the morning and something happened in China and you're down 5% in a day, and you had absolutely no control over that. You could be invested with the best company, the best PE ratio, fundamentals, leadership team, and everything, but you're being impacted by something, completely, non-related.
Yeah, but that only matters if you're trading day to day. I mean, the same thing would apply for a real estate portfolio, right? If you own real estate, the same principles would apply. It's just more illiquid, so it just doesn't happen. But the prices differ every day. If you were to sell your real estate today versus tomorrow, you'd probably get different prices, right?
Well, that's one of the things when you talk to family offices and ultra high net worth, they're making investment decisions for 25 years.
Right.
Right? We're not changing things on a day-to-day, quarter by basis. So in order to do that, you have to you have to make assessments based on fundamentals and having a long-term view.
Okay. So any as we get close to wrap it up here, any kind of tips you can leave our listeners with from a practical level of keeping a strong financial household?
Yeah, Kirk. I mean, again, I think it all starts with you, right? I mean, and looking at yourself as the biggest asset. So how can you get smart in, whether it's, different asset classes, different investing philosophy, also having an abundance mindset. Fear sells, right? So there's a lot of products, a lot of people out there that have particular agendas that want you to, you know, crawl up in a ball and not do anything, or put all of your assets into gold, right? Because that's the only safe place that you can be. But when you get educated, it can be very powerful. I've always had at least a 10x return on any investment I've made in myself. So I think that's really the best place to start.
Okay, great. Well, as we kind of wrap it up here, Dave, final thoughts from you. Where can people find more about you?
Yeah, sure. So the best place is at our website. If you're interested in this wealth strategy, we have an ebook version that you can download for free, and that's at pantheoninvest.com/wealth-strategy.
Great. Awesome. Dave, well, really appreciate you coming on the show this week.
You bet. Grateful for the opportunity, Kirk.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Dave. I really appreciate him coming on the show. And now we're into the panel portion of the show. We have our very own Megan Gorman. Hey, Megan.
Hey, Kirk. How you doing today?
Doing great. Doing great. And we also have our very own Barb Friedberg. Hey, Barb.
Good morning, everyone. Happy to be here.
Unless it's night, which case, happy evening. Barb's in the West Coast, so we're a different time zone.
It's always morning around here, unless, I'm talking to India or China, and then it's usually the evening.
Every day's perfect if you're only talking about the weather. Nothing else. All right. So let's dive right in here. Megan, what were some of your takeaways from the interview?
Yeah, it's interesting because I think one of the most misused words in financial planning is holistic. And so, I think it's really important to think about what are you looking for when you're looking for help with your finances? Because holistic typically means that all the different parts are interconnected, right? But I think it's really important when you are trying to seek advice or seek an advisor to think about all the elements that you think are important, and to also ask the advisor what elements they focus on. Because I think it's really important when you're seeking a holistic experience that everybody be on the same page. And I say this because a lot of times when I start talking to people, we're working on employee benefits like stock options or investing or something like that, or tax. And then I bring up something with estate planning, and estate planning isn't top of their list, right? And so as a result, they are, a little bit surprised that there's such an emphasis on it. So the word holistic came up a lot in this interview. And I think it's just important to think about the fact that not every advisor will have the same holistic approach. And that's important to really, really dive into.
Yeah, I think it's a great point, Megan. Barb, what were some of your takeaways?
Couple of things. First of all, you want to understand what you're investing in. So never invest in something that someone is selling you without knowing what goes into it. And this is the icky part for some of us, because there's people like Megan, Kirk, and myself. We love to pour over this stuff. We'll look at a prospectus. We'll go through the SEC documents. We know that most of you out there are not interested in doing that. But beyond that, you need to know the basics of an investment. What is going to make it grow? What is the expected reasonable return? And then if that investment makes sense to you, if the projected return profile, the risk profile is something that you think makes sense from your education, then consider investing further. If not, don't be afraid to walk away. And before you all turn off and go, oh gosh, I don't want to do this. That's why I'm hiring a financial advisor. That's why I'm going with this platform, because I don't want to do any homework. You have to do a little. And fortunately for us in the times of the internet, there's some real credible places to research investments online.
Yeah, I think it's a great point, Barb, is that you can kind of hire an advisor to do this, or you can do it yourself. If you do it yourself, you have to do all the work yourself. You can't just outsource that to somebody else. This is actually a huge issue with, like, and you can talk about this a little bit later, Barb, is some of these crowdsource funding platforms, and hey, it's easy to do, and people are doing it themselves, but they don't really do the research. So
oh, sorry, when
Go
you're
ahead.
done,
No, go ahead.
before I interrupt you, okay,
Please do.
even if you have an advisor, you need to know what he or she's talking about. And I have a kind of a embarrassing story, embarrassing about me. We recently inherited a little bit of money from my spouse's father. And I was looking for a fixed income investment about a years ago. And if any of you remember, interest rates were very, very low. And what I asked for, what I wanted, was a short-term investment, because I had a hunch if interest rates rise, it will be able to, the return will go up. So I called the fixed income specialist at one of the major brokerages, the major discount brokerage. And I was speaking with her, and she sold me on what is a preferred security investment. It was not short term. And I elected to buy it anyhow. And so it hasn't done terribly, because the coupon on the investment, or the interest rate, is 5%. So I'm getting that 5%, but I bought the investment at a premium. So I'm actually getting a little less on my individual investment. But cutting through all the jargon, the point is, I understood what I was investing in, but what I didn't really take into account was what was going to happen to this investment when interest rates rose. And the fact that I capitulated and I didn't stick with my initial goal, that was to invest in something that was short term. And now it's not a horrible investment. It's just something that I'm not as happy with as I wish I, as some of my other investments. Is that like totally confusing?
No, I mean, look, that's a challenge that we all have with our investments, right? We make a plan, and this will get into the next topic. We make a plan. Sometimes we stick to it, sometimes we don't. So I know, Megan, we talked about this before the show, but having a vision statement, having a plan in place for investments, like, how do you implement that with your clients?
Well, first of all, I mean, as a fiduciary, I have to have an investment policy statement, right? So this is a mandate for the portfolio on, what does the construction of the portfolio look like, the actual targets, withdrawals, special considerations, taxation, and so on. And I think that it's a really valuable document. We review it with clients at least once a year, because we use it as, sort of our touchstone of all the key points in their planning, right? So things from, there are Section 16 insiders, so they cannot trade a certain thing, or, deferred comp. We've made a 10-year election because they're going to leave California, because he did mention in the interview, California is expensive, and moving to Texas or so on. So for state sourcing. And it's valuable because it makes people pause and think through if it's still accurate. And what I find is that usually these statements, they last about 2 years, and then we're changing something on it. Not the asset allocation as much as some of the other parameters around the financial plan, right? And it's really, really important, because one of the things I tell my clients is we're in one long conversation together, right? So if I come into that conversation and think you're charitably inclined and you're not, and we've been working together for a very long time, I should know that, right? And we should be factoring that into the planning, and it should be part of our discussions or not part of our discussions, right? So I think it's really, really important to have some place where you have your long-term assumptions built in, knowing that over time, as life plays out, they change. I mean, often the biggest change I see is when clients retire and they get grandchildren. All of a sudden, all the parameters change. They're very comfortable staying in equities because they've got little grandchildren and they don't care about leaving money to their kids. They want to leave their money to their grandkids and different things like that. So that's how I sort of use it. And I think for most people, unfortunately, because we're required as fiduciaries sometimes to have an investment policy statement, a lot of times advisors just use it to check the box. I would make the argument you could do a whole meeting on that statement, just going through the assumptions and having, your client talk about it. And so I think for investors, doing it once a year is a good thing.
Yeah, no, I totally agree. Barb, what about you? Have you put something together like that for yourself?
It's on my to-do list. I know what I want. I have a plan for my money currently and for the future. I'm perfectly fine with that. I don't have a financial advisor. I manage all of our accounts. But on the other side, if I die, everything is a mess. So, I think that's the thing. That's where an advisor is very helpful. Or if you're a DIYer, you have to have everything in order for your heirs. And that's where I fall short. I'm not there yet. Does that make sense?
That's fair. That's fair. I think that's probably the most common situation of what most people have, right? Is that.
And by the way, the shoemaker's children always have the worst shoes.
I know.
I mean, I need to update my estate plan, and I've known this for 18 months and I still have to get it done.
I know. And I have my investment plan and it's in, 90% decent shape. I should probably rebalance. I should probably revisit a couple of things, but that's on the back burner because I'm doing other stuff. And, I have a plan this summer to get all that in order. So, hey, I'm imperfect.
Well, I think we all are, Barb. I think that's a lesson for all of us. We're all imperfect. So thank you for going first. But one thing I did want to talk about, there's a framework. I was talking to a friend of mine, Chris Hudspeth, who works with a lot of advisors, and we were having this conversation about. So I heard this framework a few years ago, which is when it talks about health, right? When you talk about your own health, like growing up when I was younger, I was always focused on growth. Stronger, faster, better, healthier, like all of that, like all the R's. And it was all about growth. And then, like maybe a year ago, I started to change my thinking because I'd read an article about when you're younger, you're focused on growth. And when you're older, you might still be focused on growth. You should be focused on is longevity, right? Because you don't need to be buff at 80, right? You need to have a health span of, whatever it is. So you're enjoying a high quality life as you age. So the concept of going from growth to longevity was a big like mental switch in my head. I hadn't even thought of that. I'm like, well, I shouldn't be, going to the gym and lifting heavy weights. I should be going focused on what's most important for longevity and like change the whole framework. And I was talking to Chris and it came up and it was like, I explained this concept to him. He's like, that's brilliant. He's like, but that also applies to investing. And for whatever reason, I never thought of it that way. I was like, yeah, because most people when they're younger is focused on growth. But once you hit a certain age and, we can determine what that age is, now it's focused on longevity. The question is it focused on number or is it focused on age or, I think that's a kind of a malleable topic, but using that kind of framework, I don't know, what are your thoughts, Megan?
In terms of like focusing on the longevity of a client, like,
well, yeah, I mean, like at what
on?
point should people change from growth to longevity? Or, if they're really wealthy, it might be on wealth preservation. That would be longevity.
I mean, I think, I think a lot of times we have parts of the portfolio that are always focused on longevity, right? And, one of the things I have worked into a lot of client strategies is, retirement healthcare planning, right? Because there are a lot of tools out there, but I don't think they're often put together the right way, right? Because, we talk about health savings accounts, HSAs, but, this is we're now getting to the first group that have had them for a considerable period of time. And how do they use them in retirement? Coupled with long-term care planning, coupled with in healthcare directives, the decision to be able to stay in one's home as long as they want. So we do run a lot of scenarios like, what if someone got Alzheimer's early? What does that do to the finances? And then what do we want to have happen with their money in terms of managing it? And so that's why, a lot of clients get to 60 and they think the asset allocation should change. And we're much more focused on, look, we don't know if you'll make it to 100 or 110 or whatever it'll be, but we've got to make sure it's there. So we've got to have these engines of growth. Now, for a lot of our portfolios, there is value in doing certain alternative asset classes. So for instance, diversified private equity, when they are a good fund, as we've talked about in previous episodes, we do vintaging. And one of the things we like about private equity is if you do a vintage every year, each of those investments are 10 years. The first 5 you're seeding them, the back 5 you're harvesting, right? So it ends up being this sort of investment that starts to feed itself over time once you have 4 or 5 vintages that you've put into play. And so a lot of times we use that layer for the portfolio to be that piece that will help grow the portfolio exponentially as someone goes through the later phases of their life. I would make the argument to some degree, diversified private equity is a great retirement vehicle for the right investors. You have to meet those parameters.
Yeah, I like that approach. Barb, what about you? How do you see the kind of the growth versus longevity?
I love this conversation. And I'm actually at the point where I'm looking at the longevity more than I'm looking at the growth. And there are a couple of things you want to think about. The going theory is when you get to near retirement age, you want to reduce the level of equities and increase the level of fixed income because you can't tolerate as much of a loss in your portfolio, given the fact that you're not earning as much as you were in the past. But there are some constraints on that. Michael Kitches and Wade Pfau have done some research in that area where they've said, yeah, at the beginning stages, you may want to reduce equities, but as you get older, you may want to increase those equities, and that will give you greater long-term wealth. I also want to give a shout out to a book that I think is hugely helpful for those of us that are in those age 60-ish, on up. And it is Wade Pfau's book is called Safety First, Retirement Planning. And one of the things he gets into is creating an income stream that can meet your basic expenses throughout your life. And we all know for most of us, Social Security isn't enough for that. Wade Pfau talks about the versatility of annuity products, which have come a very long way since, decades ago. They are much different in terms of costs, in terms of flexibility. They're also very complex. But what an annuity product can do for those of us that are, facing a period where they're not going to be earning as much as they used to is they can give us an income stream. So let's say you and your spouse earn, $50,000, $60,000 a year from your Social Security, and then you have an annuity that's going to give you an extra, $20,000 a year. Well, then let's say you're spending for your, what you need to spend is say 90,000. Well, that means you only need $10,000, $20,000 a year to take back from your portfolio. And that gives you a lot more flexibility to invest, say, in equities or a higher equities and go for a little more growth. So today, and these are things that a financial planner can really, really help you with, but there's no one set plan to make sure that your money is not going to outlast you, because in the end, that's our goal. We don't want to have more life than money.
I think that's a great quote for this episode. We don't want more life than money. All right, as we wrap it up here, Megan, final thoughts from you.
Yeah, I mean, the last thing we didn't really talk about, but he brought up on there, is he talks about the wealthy a lot. And I want to just get everyone to realize that we have a tendency to group wealth segments, right? High net worth, ultra high net worth, mass affluent, right? But wealthy, just because a certain segment of the high net worth population follows a certain path, it doesn't mean all of them do. So I just caution people when people talk about high net worth and their behaviors to realize, or any segment of wealth, that there's a lot of different people in that group who have different life experiences and have different risk tolerances. And I can tell you, my two big segments are corporate executives and entrepreneurs, two very different groups in the high net worth, ultra high net worth segment. I find corporate executives are very good about following strategy. They are good at following the plan, and they are good at risk mitigation and assessing risk of a single stock position. In comparison, entrepreneurs, I think they have a higher risk tolerance, and they are willing to throw money at ideas that, when you look at the risk profile, might not make sense, just because they are just a different mindset. So don't think when someone talks about the wealthy or so on that they're all doing the same thing. They're not. It depends on their backgrounds. So I'm Megan Gorman. You can find me at Forbes.com/Megan Gorman. Kirk, thanks for having me on.
Thanks for coming on, Megan. Love that perspective. Barb, what about you? Final thoughts?
Psychology comes into play in all of this. And so you have to know yourself. What are your values? What do you want your money to do for you? And Kirk, you've talked about this a lot, which is when you get older, you really have to come to grips with, how much can I spend? And some of us feel like we've always been frugal and we're going to be frugal till the end when we don't need to be. And this is a wonderful problem to have. And then there are those of us who have been overspenders our whole lives. And then it's like a come to Jesus moment of, now we better not be overspending because we don't have the earnings left. So know yourself, understand what drives you, figure out what you want your money to do for you. Align your values with your spending. I'm Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance, Robo-Advisor Pros, and on YouTube.
Great. Thanks for coming on, Barb. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.